Here's something you've probably heard. The biggest technology companies on Earth are sitting on mountains of cash. Google, Amazon, Microsoft, Meta, rich beyond reason, untouchable. So when they announced they were building the future of artificial intelligence, everyone assumed they'd simply pay for it out of pocket. But is that actually true? Because in 2026, something quiet and strange happened. These same cash-rich giants started borrowing money, not a little, hundreds of billions of dollars. And one of them sold a bond it does not have to fully repay until the year 2126, 100 years from now. I'm Ori Kalem. I dig into the facts about money that most people walk straight past. And this is one of those facts hiding in plain sight. The story everyone is watching on the stock market has quietly moved somewhere else entirely. 3 things today. 1. Why the richest companies in the world suddenly need to borrow. 2. The secret signal in the bond market that almost nobody is reading. And 3. Where the smart money quietly moves when a boom turns into a debt cycle. Stay with me to the end. This changes how you see it. Before we start, you need one picture in your head. For over a decade, big tech was famous for one thing: printing cash faster than they could spend it. They funded everything themselves and still had billions left over. That was the whole identity. So when these companies suddenly walk into the debt markets with their hats in their hands, that is not a small detail. That is the identity breaking. To understand why, we have to talk about what they're actually building and what it costs. Think of it like this. Imagine the most successful bakery in town. For years it made so much money selling bread that it paid for every new oven, every new shop in cash. The owner never once asked a bank for a loan. That was his pride. Then one day the owner decides to build the largest bakery the world has ever seen. Not one shop, 1,000. Industrial ovens the size of buildings. The plan is so enormous that for the first time in his life, the bread money isn't enough. So he does something he swore he'd never do. He goes to the bank. That bakery is the AI data center. The 1,000 industrial ovens are the warehouses full of computer chips that train artificial intelligence, and the moment the bread money ran out is exactly where big tech stands right now. That's not a metaphor stretched too far. That's the literal financial event of 2026. So here's what actually matters. How much does this cost? According to investment bank UBS, the combined building budgets of the major AI companies could top $770 billion in a single year. Why so high? Because training modern AI needs physical infrastructure, buildings, chips, and enormous amounts of electricity, and all of it has to be bought up front before a single dollar of profit comes back. Now hold that number against reality. Morgan Stanley, another major bank, points out that this spending is climbing towards something unprecedented. These companies are now spending almost every dollar of cash their businesses generate just to keep building. Why does that matter? Because for the past decade, that figure sat around 40%. Spending nearly 100% means the cushion is gone. When the cash you make and the cash you spend meet at the same line, there is no money left over. And when there's no money left over, there is only one place left to turn. You borrow. That is why the richest companies on Earth are suddenly issuing debt. But that's not the end of it. The size of the borrowing is one story. Where they're borrowing is the story almost nobody is telling. And this is the second thing I promised you, the secret signal. Let me bring you a number. Morgan Stanley expects AI-related borrowing worldwide to approach $570 billion in 2026. Why is that figure so striking? Because it is more than double what it was the year before. The borrowing isn't just large, it is accelerating. Here's where most people get confused. They look at all this borrowing and think, so what? These are the safest companies in the world. Of course banks will lend to them. and for a while, that was true. But borrowing has a hidden limit, and it isn't about how safe you are. Now you might be thinking, if they're so trustworthy, why can't they just borrow as much as they want? Good question. The answer is the most overlooked rule in all of finance. A market can only swallow so much debt at once, no matter who's offering it. Think of it like this. Imagine you're selling tickets to a concert. If you sell a few, people pay full price happily. But if you suddenly dump 100,000 tickets on the market in one afternoon, you have to drop the price to clear them all. Too much supply, all at once, forces the seller to sweeten the deal. That's exactly what's happening here. When a company floods the bond market with debt, it often has to offer a little extra interest to convince lenders to take it all. Bankers call this a concession. Why does it matter to you? Because that extra interest is a crack, the first visible sign that even the mightiest borrower is straining the limits of the market. And this is where the geography comes in. The American bond market, the deepest pool of lending money on the planet, started to feel too small for the appetite. So the tech giants did something remarkable. They went abroad. According to reporting tracked across the financial press, hyperscalers issued essentially zero foreign currency bonds in 2024. By the middle of 2026, foreign currencies made up nearly half of their borrowing. Why the sudden shift? Because when one market can't feed you, you go to all the others: euros, Japanese yen, Canadian dollars, Swiss francs, British pounds. And the detail that stops me cold is this. Alphabet, the parent company of Google, reportedly issued a bond denominated in British pounds that doesn't mature for a full century, a 100-year loan. Why would any company borrow money it won't fully settle until the year 2126? Because they're betting that what they build will still be generating money 100 years from now. That is either the most confident bet in modern business history or a sign that they'll reach for any pocket anywhere in any currency to keep the building going. Reasonable people read it both ways. Hold on to that tension. Now, blind optimism is dangerous. Let's check the other side honestly. This is analysis, not investment advice, because there is a genuinely strong case that all this borrowing is perfectly fine, and you deserve to hear it. The companies doing the borrowing start from real strength. They have powerful businesses, steady profits, and balance sheets most nations would envy. Why does that matter? Because a borrower who earns a fortune every quarter can service debt for years without strain. This is nothing like a household drowning in credit cards, and the demand may genuinely justify the spending. Industry analysts argue that AI computing power is so scarce right now that every warehouse they build gets used immediately. Why build so fast? Because if the demand is real and lasting, the company that hesitates loses the race, and the loan looks cheap in hindsight. But don't get carried away. Let's be objective about the risks, because the same facts, read coldly, point to real danger. And the sharpest worry doesn't come from me. It comes from the lenders themselves. One bond investor put the fear plainly. He lends money for, say, 8 years. But what if the expensive chips inside these data centers are made obsolete by a competitor in just 3? Why is that terrifying for a lender? Because he'd be holding a loan against a building full of machines that no longer earn their keep, 5 years before he gets paid back. There's a second risk. All this new debt has quietly changed the relationship between these companies and their investors. For years, the unspoken deal was simple. We lend to you, but you fund your big bets with your own cash. By moving those bets into the debt markets, the question shifts from, is this a great company, to how creditworthy is this company really? That's a colder, harder question. And the third risk is the simplest of all. If the wider economy tightens, if lending money becomes scarce and expensive, the companies that lean hardest on borrowing feel it first. Why? Because debt has to be refinanced, rolled over, paid again. A boom built on borrowing is only as stable as the lending behind it. This is how the big money, the smart money, actually reads it. They are not staring at the stock price anymore. They've turned their attention to something most ordinary investors never even glance at: the bond market. Specifically, they watch something called the credit spread. Don't let the term scare you. It's simple. It's just the extra interest a company has to pay compared to a government, which is treated as the safest borrower. Why watch it? Because it is a live measure of fear. When that gap widens, lenders are getting nervous. So while the crowd cheers every flashy product launch on the stock market, the professionals are quietly tracking how much extra these tech giants must pay to borrow. That number is the real thermometer of the AI boom. It moves before the headlines do. 3 checkpoints to watch, just 3. These are the signals that tell you the story is turning real, and you don't need a finance degree to follow them. Checkpoint 1. The size of new bond sales. Watch for the words record and jumbo attached to tech debt deals. Why? Because each new giant sale tests how much more the market can absorb before it strains. Checkpoint 2. The spread of foreign currency borrowing. If the tech giants keep reaching into ever more distant currencies, that tells you the home market is full. Why does that signal matter? Because it reveals appetite outrunning supply, the borrower searching the whole world for one more lender. Checkpoint 3. The credit spread itself. You can find it reported in the financial press. If it stays calm, the boom is funding smoothly. If it widens sharply, the lenders are pricing in trouble. Why trust it over the headlines? Because money moves before opinions do. Don't overcomplicate it. Hold one realistic picture in your head. The AI boom has quietly stopped being a story about software and clever products. It has become a story about debt, about who is willing to lend the trillions needed to build it and at what price. But step back, there's a bigger picture worth seeing here. Every great industrial leap in history, railroads, electricity, the early internet, eventually moved from being funded by excitement to being funded by borrowing. That shift is normal. It is also exactly the moment when the winners and the casualties get separated. When a boom runs on a company's own cash, a mistake is painful. When a boom runs on borrowed money, a mistake is dangerous, because the debt has to be repaid whether the bet worked or not. That is not a prediction of disaster. It is simply the rule that governs every cycle built on credit. If you remember one thing today, make it this. The most important number in the artificial intelligence story is no longer a stock price. It is the interest rate these companies must pay to borrow. Watch the lending, not the launches. I find these quiet shifts far more revealing than the loud ones. The headlines will keep celebrating the next product. The truth, as usual, is sitting somewhere quieter in a bond document written in pounds that comes due in the year 2126. If this made something click, a like genuinely helps. What are you watching right now? Tell me below. I read them. Until next time, this has been The Vault